Well, the inflation data was just released and it is just not going down. It is just sticky. And as a result, stocks are absolutely swirling around the toilet. But there's a much larger problem with this that is going to absolutely destroy your portfolio because the beatdown is not over yet. It's not going to be contained just to one day. There's a lot of repercussions to this number that we need to talk about because I see big trouble on the horizon. But don't worry, guys, we'll absolutely discuss that, why it's happening, and more importantly, exactly how I'm going to handle this little time period right here that we have, and kind of talk about everything else in between. Just make sure you like the video if you like getting the truth without the hype. And make sure you check out the pinned comment down there for my new channel where we talk about financial freedom and retiring early. Again, it's the pinned comment down there. And the Valentine's Day sale for my group is ending tomorrow. Just check out the pinned comment down there and see if a membership's right for you, because monthly memberships are going away because of our stock revamp that's coming here shortly. So why exactly is inflation so stubborn? What the heck are all the repercussions of all that? And why is it going to destroy your portfolio potentially? Well, there's actually 3 things that explain it. So we'll talk about those. Then we'll talk about how it can destroy your portfolio and exactly how to handle that. And I'm going to do something a little bit different to kind of explain all this and to kind of get you guys an answer to that. So number 1 is the economy is still growing at a ridiculous pace. Now look, I know some folks don't want to hear this, but just hear me out all the way through this. A good GDP print for a quarter is basically in the 2s. That's kind of considered kind of average, kind of normal, kind of optimal. That's where you want to be. But 2 quarters ago, we were in the 4s. And just last quarter, we were well into the 3s, which means the economy is red hot still. I don't care about any of the other narratives that are out there around the economy. The data says, and the data is showing that the economy is red hot. And if you're one of those folks where you're like, oh, I don't believe the government data, I think they're just lying about the numbers or whatever the case is, well, guess what? Earnings are showing the exact same thing. Earnings are red hot. We are seeing record profits across the board. Every single piece of data is showing that the economy is red hot. So even if you don't believe the government data, okay, fine. Guess what? Earnings are saying the same exact thing. So unless you think the government's rigging the data and all the companies are rigging the data, which then means Wall Street would have been on it, then they're rigging the data too, and everybody's just rigging the data all the way around. That's the only way that's all possible. And to me, that seems a little bit far-fetched. And bottom line is that all signs are pointing toward the economy running red hot. And that means we're going to see more inflation, or the fight against inflation is going to be a lot harder. The second is greedflation is very real. Now, I'll do a longer form video on this later because there's a lot of neat studies that are out there that are actually showing specifically with data exactly what is happening with greedflation and that it's happening, and it's very prominent. But to kind of recap it in short form here, the studies all showed that the initial rise in prices was absolutely companies scrambling to cover the increase in prices that they were seeing in regards to inflation. But it didn't take long for them to figure out that, hey, they're no longer just covering their cost of inflation. They're also giving themselves additional profits on top of that. And as it kind of started, and as they kept doing it, and as it kept working, and they kept seeing record profits after record profits, most companies out there continue to do it well past the time of just passing on the cost of inflation to us as consumers. They were basically juicing the bottom line. And again, when you go back and look at the earnings data, it has shown exactly that almost across the board. It's not every company, but almost across the board. Every single one of them have juiced profits well beyond what was a reasonable profit margin or what a reasonable amount to add for the cost of inflation that was impacting their business in the first place. The data supports that. And you also had CEOs on earnings calls saying that they were doing exactly that. Basically, saying things like, hey, we raised our price and we saw no slippage in demand, so we're going to continue to raise prices until we see demand finally start to falter and to where it actually starts to affect our bottom line, which I would suspect that a lot of companies still haven't found that mark yet. They're still selling at record levels despite super elevated prices. So how exactly do we stop this? I mean, how do we actually stop these companies from doing this and from this basically contributing to the problem even more? Well, here's the honest truth, guys. We have to stop buying. That's the honest truth. You have to vote with your wallet. Complaining about it on a message board or in the comments here or just to your coworkers or anybody else means absolutely nothing if you go home and you still make the purchase anyways, or you go to the store and you still make the purchase anyways, or you go out to eat at that same restaurant again that has jacked the price from $8 for a burrito to $18 for a burrito, and you still continue to order the same exact thing. You punish with your wallet by not using your wallet at the particular companies that are doing this specifically. Otherwise, we're all just encouraging their bad behavior to continue to juice profits. And number 3, higher interest rates just switch to spending instead of slowing the spending. I know that didn't make a lot of sense here, but let me explain it. Whenever you look at this and exactly what's happening in regards to this, you're seeing certain segments cool off significantly, like housing, for example. You're seeing housing, not prices. Unfortunately, prices haven't fallen because we don't have enough inventory coming in to get prices to fall. But in terms of number of sales and the volume of sales, that's slowed significantly. But instead of spending there, people are just spending their money in other places. And you see that in things like the travel industry and a lot of other more experience-oriented places. Service industries and things of that nature are seeing record profits after record profits, despite ridiculous prices to just take an hour flight somewhere. I know for me, that flight, I had a flight consistently that I took multiple times a year that was anywhere from, you could get it under $100 up to around $150 or so. That is almost $1,000 flight now routinely, and the plane is packed. So higher interest rates basically moved us from, spending on things that are very interest rate sensitive, like cars, like homes, stuff like that. And we didn't stop spending. We didn't just go, oh, all right, well, I'll delay that car for another year and I'll save that money. Nope, we're just taking it over here and we're spending it in a different area. And that was probably something the Fed probably didn't think was going to happen. Was they thought when we raised interest rates, everybody would kind of slow down the spending a little bit, kind of across the board. And it hasn't happened. We just kept the same spending. Matter of fact, we've actually increased our spending rate. And we just kind of moved it from these sectors over here that are more interest rate sensitive into less interest rate sensitive industries over here. And of course, whenever we shift our spending over here to these other areas, those companies start ramping up and spending money on the offerings for you as a consumer, and of course, raising the prices and everything else. So, it's basically we're spending over there, they're spending in order to offer us more because they're seeing huge demand over there. And that's what's kind of juicing the economy. So all it did was just kind of transfer the spend from over here to over here. So how exactly is all this going to screw you and your portfolio, and what can you do about it? Well, it basically reinforces the fact that the Fed is not cutting anytime soon. And I think when they do finally decide to cut, which I think it's going to be summertime at least, at a minimum, they're going to be very small cuts and they're not really going to have massive impacts. And it's definitely not going to be anything that Wall Street wants to see, which means more pain for the stock market. We saw that in the reaction this morning, basically sealing the fate that all the people that thought we were going to get a cut here in the spring, which I thought was utterly dumb. And we'll talk about that here in just a second. But the facts are that dream kind of is dashed. And now they know it's going to be delayed at least another quarter, maybe even more, depending upon the data that continues to come out with CPI over the next few months, which of course means Wall Street is going to sell off stocks for no good reason other than that. Now, again, I don't know why people were thinking it was going to be a cut in March. I guess it's just they've been wrong this entire time. This entire rate cycle, hike up and back down. The analysts, the people on the news, YouTube, everybody has been ridiculously wrong. And I don't really know why, because Jay Powell has earned a lot of the criticism that he gets for missing a lot of different things. But one thing he's done well is communicate exactly what's happening. And then as the data changes, he'll be a few months ahead in communicating, hey, we shifted our plan. Now our plan is here a little bit based upon the data. And so guessing when they're going to cut interest rates has been pretty clear this entire time. But yet Wall Street started wanting and predicting interest rate cuts. Basically, they thought they were going to cut, and there was a big talk about cutting a summer ago. It was just crazy. I had no idea what the heck people were thinking. They have been wrong routinely every single time. I got it. It drives trading. There's probably other games being played there, but it's why I completely ignore all that stuff and I don't listen to any of it, because it has routinely been wrong this entire time. Bottom line is inflation is sticky, and the Fed is not going to make significant strides in lowering the rates significantly for quite some time. We might not see it obviously this year, and it might be in the future before we see that. So that longer for higher thing is very, very much a real thing, and it kind of feels like Wall Street is coming around to that. And of course, that means they are going to beat down stocks. So how exactly do you deal with this complete mess? Well, I'm going to take a little bit of a different angle here, guys, this time around. So kind of stick with me all the way through till the end, because I promise it'll be worth it and it'll kind of give you some clarity on what to do. So number one is I'm not going to start trading this. Even though I think I have a pretty good feel for where this thing is going, I am not going to make the mistake of all of a sudden becoming a trader and trying to trade this and trying to play all these other games. I might get lucky, you guys might get lucky, but it's not a sustainable long-term strategy per se. And more importantly, I need to stick with the fundamentals. Those fundamentals were what drove me to buy so heavy, put more money in the market I ever did in 2022, and then continue to put money into opportunities that did pop up in 2023, despite the runs as well, which are now being rewarded this year with runs up in particular stocks this year. So I'm not magically going to start trading this all of a sudden, because now all of a sudden I'm a trader and I got a good feel for what's going to go on in the market. Number two, I'm going to execute my buys as planned. This kind of goes along with the first one, I know, but it is so easy to deviate from your plan when you feel like, wow, nothing's lining up here. These stocks are going to go lower. That could very well be true, but I'm going to stay disciplined and buy at my price targets, because I don't know when that switch basically is going to flip. You saw this with Tesla, last year, 2023, at the very, very beginning of it. If you remember correctly, it got down to $100, which was a screaming deal, even at its depressed level today, where it's not really gone anywhere. You're still up 70, 80% on those shares if you bought, but people were waiting for it to dip more, because now the charts and all the graphs and all the gurus were all saying it was going to 80 and then potentially 60. And before you know it, you just missed it. And maybe your original plan was to start buying at 150 or so, but you kind of went, yeah, I think it's going to go lower. And then it did. It went down to 130. So then you went, okay. All right. Well, I think it could go lower here. The charts are all saying this, whatever. And then it dipped down to 110. And you're like, oh man, I'm like a genius here. And then you start looking at it again as it continues to fall. You're like, yeah, that $90 mark, that's where I'm going to jump in at. That's it right there. And then obviously it got down to right around $100 or so, started its way back up. And you're like, oh, it's just a fake out run. It'll be right back down to the $80 mark. And then before you know it, you were trying to pay $200+ for the stock, as opposed to being able to pick up shares at the 150 where your plan was, and then just DCA on the way down as it fell. So I'm going to stick with my plan and execute my buys as planned and not play that game. And number three, I'm going to understand the bigger picture. Look, there's a much bigger picture to all this, and there's a lot of different things that kind of follow into this, but some of them are the Fed is eventually going to cut rates significantly to get the economy going again and to kind of bring us out of this malaise and to make things more affordable for everybody, especially on the housing front and some other things like that. The Fed will eventually do that big picture. I also know that stock price has nothing to do sometimes with company performance. Just like we saw Meta in the 80s, that had nothing to do with their performance and everything with Wall Street being dumb. So I'm not going to directly correlate the stock price going down all of a sudden to my company's not performing. I care about what happens on earnings, not what the stock price is doing. Those things get decoupled all the time in the stock market. I'm going to make sure I keep that in mind. And finally, I'm always going to remember that share count matters more than your average in the end. So I'm just going to continue to add, continue my DCA and stocks I'm DCAing into, and move forward with that, because I know in the long run, 10 years from now, I will be so glad that I just added shares, and I won't necessarily care that much about my average 10 years from now if these stocks continue to perform as companies. And the Valentine's Day sale for my group is ending tomorrow, so make sure you check out the pinned comment down there if you want to take 5 courses for free, see all my buy and sell alerts in real time, see my watch list complete with price targets, be able to use our stock analyzer tool completely for free, be a part of the best 6, 7, and 8-figure Discord out there. And guys, there's so much more coming to the group. I'm so excited. Just check out the pinned comment down there and see if a membership's right for you, because monthly memberships are going away because of our stock revamp that's coming here shortly. And click this video here if you want to see exactly what I'm buying in this market, and click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.